While most people were distracted by headline inflation prints, election cycles, and day-to-day market noise, something far more consequential began shifting underneath the global financial system. Capital did not panic, it did not flee in a single dramatic crash. It migrated, slowly, deliberately, and at scale, across borders, asset classes, and currencies. That movement is still underway, and by the time it becomes obvious to the crowd, the repricing will already be complete. The core event can be stated simply: global capital is being reallocated away from long-duration, low-return, policy-dependent assets and toward jurisdictions, instruments, and structures that offer liquidity, yield certainty, and political insulation. This is not a temporary trade. It is a structural migration driven by incentives, constraints, and balance sheet math. Most observers are missing it because capital migration does not look like a crisis in real time. There are no circuit breakers, no single day where everything breaks. Instead, the signals appear fragmented. Foreign reserve composition changes measured in quarterly reports, cross-border banking flows buried in BIS data, sovereign issuance shifts from fixed to floating rate, and commodity trade settling in alternative currencies. Each data point looks small on its own. Collectively, they describe trillions of dollars quietly changing behavior. The forcing mechanism behind this migration is the global repricing of risk after the end of the zero-rate era. From 2009 through roughly 2021, capital was conditioned to one environment: suppressed volatility, abundant liquidity, and policy backstops that made duration risk appear harmless. That regime ended when global policy rates moved from near 0% to a 4 to 6% range in under 2 years in several major economies. A U.S. 10-year Treasury yield moving from 0.5% in 2020 to a 4 to 5% range fundamentally changes discount rates, refinancing costs, and asset valuations worldwide. Now here's where it starts to matter. When rates rise this fast, existing capital structures break symmetry. Assets priced for low discount rates, long-duration equities, venture capital, speculative real estate, highly levered sovereigns must either reprice or be abandoned. Capital, unlike labor or infrastructure, can move, and it does. According to BIS-reported cross-border banking flows, gross international claims shifted by several $1 trillion between 2022 and 2024, estimate based on aggregate reporting, with a clear tilt toward short-term instruments, higher-yielding sovereign debt, and commodity-linked trade finance. At the same time, governments are issuing debt at record nominal levels. Global sovereign issuance exceeded $10 trillion annually in recent years, approximate range, colliding with higher interest expense. When debt service rises faster than revenue, balance sheets become fragile. Capital notices, it demands compensation, or it leaves. This is the part most people miss. Capital does not wait for confirmation. It moves on probability-weighted outcomes. Rising geopolitical fragmentation, sanctions risk, supply chain reshoring, and currency volatility all increase the value of flexibility. Money flows toward systems that can absorb shocks, and away from those that rely on uninterrupted trust. What's at stake is not just market performance. It is inflation dynamics, currency stability, credit availability, and recession risk. When capital migrates, borrowing costs change. Investment slows in some regions and accelerates in others. Entire supply chains reprice. To understand why this capital migration is happening now, and why it is unusually large, you have to strip the story down to mechanics, not narratives. Capital does not move because of headlines. It moves because relative returns change under constraint. At the center of the mechanism is the repricing of time, risk, and liquidity. For more than a decade, global markets operated under an implicit assumption. Duration risk was cheap, refinancing was easy, and central banks would intervene aggressively if asset prices fell too far. That assumption shaped everything from venture capital funding models to sovereign debt maturity profiles. When policy rates were near zero, the difference between a 2-year bond yielding 0.2% and a 10-year bond yielding 1.5% felt trivial. Investors reached for yield, accepted illiquidity, and extended duration because the penalty for being wrong was low. That world ended when inflation forced policy normalization. When benchmark rates moved from 0% to 4 to 6%, the math flipped. Duration stopped being a passive feature and became an active risk. A simple numerical example makes this concrete. Consider a 10-year bond issued at a 1.5% coupon. When yields rise to 4.5%, the market value of that bond drops roughly 20–25% depending on convexity. That is not a paper fluctuation, it is a balance sheet hit. Banks, pension funds, insurers, and foreign reserve managers all felt it simultaneously. Now here's where the migration begins. Institutions with mark-to-market constraints or regulatory capital requirements cannot simply wait it out. If asset values fall, leverage ratios worsen. If leverage worsens, exposure must be reduced. The fastest way to reduce exposure is not to sell everything indiscriminately, but to rotate into assets with shorter duration, higher carry, and better liquidity. Treasury bills yielding 4 to 5%, short-term repos, commodity-linked trade finance, and select high-yielding sovereign debt suddenly become competitive again. This is the part most people miss. The migration is not primarily about chasing returns. It's about avoiding refinancing risk. Globally, more than $60–70 trillion in sovereign and corporate debt is outstanding, approximate aggregate. A large share of that was issued during the low-rate era and must be refinanced over the next 3 to 5 years. When refinancing costs double or triple, free cash flow disappears. Capital responds by demanding higher yields, shorter maturities, or collateral. If those conditions are not met, funding dries up. That dynamic forces behavior. Governments shorten issuance, corporations delay investment, banks tighten credit. Meanwhile, capital that once funded speculative growth reallocates toward instruments where cash flows are immediate and contractual. Another key transmission channel is currency risk. Higher rates in reserve currency economies increase the opportunity cost of holding lower-yielding foreign assets. If a fund can earn 5% in dollar terms with minimal duration risk, holding assets yielding 2% in a volatile currency becomes irrational unless compensated. That differential drives FX hedging costs higher, which further discourages cross-border investment into weaker balance sheets. The result is a feedback loop. As capital migrates toward perceived safety and yield, borrowing costs rise elsewhere. Rising borrowing costs worsen fiscal and corporate metrics, validating the initial migration. This is not a crash mechanism. It is a slow drain. Liquidity doesn't vanish overnight. It becomes selective. Markets still trade, but on worse terms for those who need capital the most. And here's the uncomfortable reality. Once capital migrates structurally, it does not return easily. It requires either a collapse that forces intervention or a regime shift that restores confidence. Next comes the pressure this mechanism creates. Once capital begins migrating, the critical question is not where it goes, but who is forced to react first. Capital mobility creates winners and losers asymmetrically, and the pressure concentrates on actors with the least flexibility and the most rigid obligations. This is where the system stops being theoretical and starts becoming mechanical. The first group under pressure is sovereign borrowers, particularly those running persistent fiscal deficits. Governments do not face margin calls in the traditional sense, but they face something equally constraining: refinancing calendars. When a country has 20–30% of its outstanding debt rolling over within 24 to 36 months, a common range for many developed and emerging markets, rising yields are not optional information. They are binding constraints. If average borrowing costs rise from 1.5% to 4.5%, annual interest expense triples on new issuance. For a government with debt equal to 100% of GDP, that difference can mean an additional 3% of GDP per year in interest costs over time. Either taxes rise, spending falls, inflation accelerates, or borrowing continues at worsening terms. There is no fourth option. Now here's where it breaks. Governments cannot easily shrink balance sheets during economic slowdowns, so capital demands higher compensation. If it does not receive it, it reallocates. This is why we see growing divergence between countries with credible monetary frameworks and those relying on financial repression or regulatory coercion to retain capital. The second pressure point is the banking system, especially institutions holding long-duration assets funded by short-term liabilities. Banks are structurally leveraged maturity transformers. When yields rise quickly, unrealized losses grow. Even if assets are held to maturity, depositors do not think in accounting categories. If deposit rates lag market rates by 300 to 400 basis points, deposits migrate. Banks must then either raise funding costs, shrink balance sheets, or sell assets at a loss. Each option tightens credit availability. The third group under pressure is leveraged investors, private equity funds, real estate vehicles, hedge funds, and risk parity strategies. Many of these structures were built on the assumption that financing would remain cheap and liquid. When funding costs rise from 2% to 6%, leverage that once amplified returns now amplifies losses. Covenants matter again. Cash flow coverage ratios become binding. The binary choice emerges. Either assets generate real cash flow now, or leverage must come down. This is the part most people underestimate. Capital migration does not require panic selling. It only requires refusal to roll funding on old terms. When lenders say, same loan, Higher rate, shorter maturity, behavior changes instantly, investment pauses, hiring slows, asset prices soften, not because of fear, but because of math. Households also become pressure points, particularly in housing markets. When mortgage rates move from 3% to 7%, affordability drops by roughly 30 to 40% for the same monthly payment. Demand does not disappear, but it freezes. Transactions slow. Prices stagnate or decline in real terms. Construction activity responds with a lag, feeding back into employment and growth. A useful historical parallel is the early 1980s Volcker tightening, when capital rapidly shifted toward dollar assets as real yields turned positive. The similarity lies in the speed of repricing. The difference is scale. Global leverage today is far higher, and financial systems are more interconnected. That means pressure transmits faster, even without overt crises. Here's the binary framing that defines this phase. Either cash flows adjust to higher rates, or balance sheets do. Capital does not negotiate. It reallocates. In the next chapter, we move from pressure to proof into the numbers that show why this migration is not a narrative, but a balance sheet reality. If the first 3 chapters explained why capital is migrating and who is under pressure, this chapter answers the harder question: how do we know this is real? The answer is not opinion or sentiment. It is arithmetic. Balance sheets do not lie, even when markets appear calm. Start with the most basic constraint: supply versus demand for capital. On the supply side, global savings are not expanding fast enough to absorb the surge in issuance at current prices. Aging populations in developed economies are drawing down savings, not adding to them. At the same time, governments are issuing debt at historically high nominal levels. Global sovereign issuance has averaged roughly 10 to 12 trillion per year in recent years, scenario range based on IMF and issuance aggregates. Corporate issuance adds several trillion more. Against that, the pool of buyers willing to hold long-duration risk at low real yields has shrunk. Why? Because real yields are no longer negative. When inflation was running above yields, holding long bonds was tolerable. Inflation eroded the real value of debt. That dynamic reversed when policy rates rose. In many developed markets, real yields move from approximately 1% to plus 1 to 2%. That shift alone reallocates capital. A pension fund that once needed risk assets to meet return targets can now meet obligations with shorter duration fixed income. Demand for speculative duration falls, not because of fear, but because it is no longer necessary. Now look at debt service math, where the pressure becomes undeniable. Take a simplified scenario. A government with debt equal to 100% of GDP rolls over 20% of that debt annually. If the average interest rate on new issuance rises from 2% to 5%, the incremental interest cost on rolled debt alone is 0.6% of GDP per year. Over 5 years, as more debt resets, interest expense can rise by 2 to 3% of GDP, even without additional borrowing. That is fiscal tightening by arithmetic, not policy choice. Either deficits widen, spending is cut, or inflation absorbs the burden. Capital responds to that trajectory before it is visible in budgets. Next, examine cross-border flows. BIS data shows that gross international banking claims shifted materially between 2022 and 2024, aggregate estimates in the low single-digit trillions. Importantly, the composition changed. Short-term claims and dollar-denominated exposures increased relative to long-term local currency lending. This tells us capital is prioritizing liquidity and optionality, not expansion. Trade settlement data reinforces the point. A growing share of commodity and intermediate goods trade is being settled outside traditional long-duration financing structures. Inventory drawdowns in certain commodities have coincided with higher financing costs, discouraging speculative stockpiling. When carrying costs rise, inventories fall. Lower inventories increase volatility. Volatility further increases required returns. The loop tightens. Now consider institutional positioning. Pension funds, insurers, and reserve managers operate under duration and liquidity constraints. When yields rise, their optimal portfolios change mechanically. Even a 5-10% reallocation from equities and long bonds into short-term instruments represents hundreds of billions of dollars. These are not discretionary trades. They are policy-driven reallocations. To make this concrete, consider 3 simplified scenarios. Scenario A, benign. Growth holds, inflation stabilizes, and rates plateau. Capital migration slows but does not reverse. Long-duration assets stabilize at lower valuations. Scenario B, base case. Growth softens, refinancing costs bite, and issuance remains high. Capital continues migrating toward short duration and high liquidity assets. Credit spreads widen modestly. Scenario C, stress. Growth contracts while issuance remains elevated. Capital accelerates migration, liquidity becomes selective, and weaker balance sheets face funding gaps. Across all three scenarios, one conclusion holds: the old pricing assumptions no longer clear the market. That is why normal expectations fail here. Capital is not disappearing. It is repricing time, risk, and trust. When markets respond to this math, the reaction often looks chaotic. In the next chapter, we examine how markets transmit this pressure and why the reactions feel irrational, but aren't. When large-scale capital migration reaches this stage, markets do not respond in straight lines. They respond through transmission mechanisms that amplify small imbalances into visible price moves. To the casual observer, the behavior can look emotional or irrational. In reality, it is structurally logical, driven by liquidity, positioning, and constraints. The first visible reaction is repricing through gaps rather than trends. Markets accustomed to abundant liquidity begin to discover that bids are thinner than expected. Prices do not drift lower, they reset. This is why assets can appear stable for weeks and then reprice sharply on seemingly minor news. The news is not the cause. It is the excuse that allows price to move to where liquidity actually exists. One of the earliest signals is spread behavior. Credit spreads widen before equity markets react. The difference between yields on investment-grade or high-yield debt and risk-free benchmarks reflects funding stress. A widening of even 50-100 basis points in credit spreads materially increases borrowing costs, especially for issuers that rely on continuous market access. That increase feeds back into earnings forecasts, which then justify lower equity valuations. Cause precedes narrative. Liquidity-sensitive strategies amplify this process. Risk parity funds, volatility targeting strategies, and certain hedge fund models adjust exposure based on realized and implied volatility. When volatility rises, these strategies mechanically reduce risk. That selling is not discretionary, it is rule-based. As volatility increases, exposure decreases, which can push volatility higher still. This is how feedback loops form without any single actor intending to cause disruption. Now here's the part most people miss. Capital migration changes correlations. Assets that once moved together decouple. Long-duration equities may fall even as short-term rates stabilize. Certain commodities may rise due to supply constraints while industrial demand weakens. Currency moves can dominate asset returns, especially when funding currencies strengthen. These correlation breaks confuse observers who rely on historical patterns, but they are consistent with a system repricing liquidity and balance sheet resilience. Another transmission channel is forced liquidation. This does not require widespread insolvency. It only requires mismatched time horizons. If a fund holds assets that take months to sell but faces daily or weekly redemptions, it must liquidate what it can, not what it wants. That means the most liquid assets are sold first. Prices fall where liquidity exists, not where risk is highest. This creates the illusion that safe assets are under pressure while weaker assets appear stable, until they are not. Equity markets often lag these signals because earnings reports arrive quarterly while funding markets react daily. By the time earnings revisions reflect higher interest expense and weaker demand, capital has already moved. The market reaction feels sudden, but it is the delayed recognition of a process already underway. What should observers watch during this phase? Not headlines, but plumbing, yield curve shape, particularly term premium changes, credit spreads across ratings, dollar strength relative to funding currencies. Volatility indices and options skew ETF flows, especially in fixed income repo and short-term funding rates. When liquidity tightens, price discovery accelerates. Moves become discontinuous. Commentators search for explanations, but the explanation is structural. Capital is enforcing discipline where policy once delayed it. This is why reactions often overshoot. Markets must move far enough to attract marginal buyers with higher return requirements. Until that happens, prices search lower or higher depending on the asset's role in the migration. The final piece is timing. Markets can endure imbalance longer than expected, then adjust faster than seems possible. That brings us to the roadmap, how this typically unfolds across weeks, months, and quarters, and what indicators matter most. When you're ready, we'll conclude with Chapter 6, the roadmap, timelines, scenarios, and signals. Chapter 6, the roadmap, timeline, scenarios, and structural signals. At this stage, the capital migration is not a forecast. It is a process already in motion. The only uncertainty is speed and intensity, not direction. To understand what comes next, the roadmap must be framed in time horizons and scenarios, because markets do not move all at once. They move in layers. Near term, next 24 hours to 2 weeks. In the immediate window, markets are dominated by liquidity conditions rather than fundamentals. Short-term funding markets, repo rates, and treasury bill demand provide the earliest signals. If capital continues prioritizing liquidity, demand for short-duration instruments remains elevated even during equity rallies. Watch for persistent demand for bills yielding 4 to 5% despite risk-on sentiment. That divergence indicates caution beneath surface optimism. Volatility may remain episodic rather than continuous. Single data releases can trigger outsized reactions because positioning is light and conviction is low. This is not instability. It is price discovery under constraint. Short-term, 1 to 3 months. This is where refinancing math begins to matter. Corporate earnings calls shift tone, not because revenues collapse, but because interest expense guidance rises. Banks tighten lending standards incrementally. Credit spreads become the dominant signal. A sustained widening beyond 75 to 100 basis points in key sectors confirms that capital migration is accelerating rather than stabilizing. Housing activity, capital expenditure plans, and inventory accumulation respond with a lag. When transaction volumes slow without price collapses, it signals capital hesitation rather than panic. Medium term, 1 to 2 quarters. By this phase, balance sheets, not sentiment, drive outcomes. Governments face higher interest expense, corporations delay investment, and labor markets soften at the margin. Capital continues reallocating toward jurisdictions and structures that offer predictable cash flow, legal certainty, and liquidity. This is where regime narratives break. Markets that relied on perpetual multiple expansion struggle. Others stabilize sooner because yields now do the work that price appreciation once did. Scenario framing. Base case, most likely. Growth slows but does not collapse. Inflation moderates unevenly. Rates stay higher for longer. Capital migration continues steadily. Long-duration assets underperform in real terms. Credit remains available but expensive. Key indicators: credit spreads, real yields, bank lending surveys. Stress case: liquidity tightens faster than expected. Refinancing risk surfaces in weaker balance sheets. Credit events increase, not systemically, but in clusters. Capital accelerates migration toward cash-like instruments and high-quality collateral. Key indicators: funding spreads, forced asset sales, sharp correlation breaks. Relief case: inflation falls quickly, allowing rates to stabilize or decline modestly. Fiscal discipline improves credibility. Capital migration slows, but does not reverse. Valuations reset rather than rebound. Key indicators: falling real yields, narrowing credit spreads, stable currency markets. Across all scenarios, one truth holds. Markets are no longer priced for frictionless capital. Liquidity has a cost again. Time has a price again. Trust is being measured rather than assumed. This is why the largest capital migration in modern history feels invisible. It is not dramatic, it is methodical. Capital is simply doing what it always does, moving toward structures that survive stress rather than promise growth.